Well, hi everyone, this is Joanne Holes. Today's webinar is going to be on Social Security and income planning. So we're going to get going here. I just want to tell everyone that we are doing a live version of this Saturday at the First Bank here at 10:30. So it'll be a live version, but this is our webinar. So welcome and let's get going. So a little bit about us. I'm a certified financial planner and a fiduciary, which is very important in our industry. A little bit more about that later. We do comprehensive financial planning, basically all these areas of focus. There's a lot of them, but they're important and they don't stand alone. They really all mesh together. You want to look at all of those issues when you're planning your retirement. We're located in the First Bank of Belmar and Lakewood, and we are not affiliated with the Social Security Administration. I've been doing classes for about 10 years now on Social Security. So let's get going. So Social Security and income planning. See these two pictures here. When you're working, investing is pretty straightforward, really. You're just putting money in, hoping your values will go up over time, and you're paying into Social Security probably, and paying into or getting a pension of some sort, perhaps. So you're putting money in, but when you're close to retirement or in retirement, there's a whole new set of skill sets that you need someone to help you with if you're not familiar with them. I mean, for one, you want to preserve your assets because you're not putting more money in anymore. You're drawing it out, so you want to preserve them, and you want to know which bucket of money, which should you take money from first, something that's taxable, tax-free, or tax-deferred. So you want to make sure you're doing those things. You want to make sure that your money is going to last as long as you do. So you do a little budget planning and things. You're looking at Medicare issues, long-term care issues, all kinds of things that come together. And the main one is what we're talking about today is Social Security. When should you take Social Security? And that's not a simple answer. It really depends on everything else that's going on in your life and how that fits in there. Social Security can be taxable. We're trying to reduce that. We're trying to put this all together to reduce taxes, have as close to a pretty confident paycheck that lasts you as long as you do, So let's get going here. So in this presentation, we are going to talk about Social Security basics. When should you take it? Spousal benefits, how working and taxes affect your benefit, common reasons why retirees run out of money, how should you invest your money to last through retirement. So those are the things we're going to hit here, and they're all related. Here's a study that the Nationwide Retirement Institute put together. They do it every year, and they look at how do people feel about Social Security and how knowledgeable are they about a pretty big chunk of their retirement. Basically, 88% don't know what factors determine the maximum Social Security benefit a person can receive. That's a lot, basically. That's a lot. And it looks up here, too. It says the average benefit, just for your information, is that people receive is $1,360 a month. Only 13% of older Americans have a financial advisor who provides advice on Social Security. And those with an advisor, here's the big part, receive greater than 20% more in their benefit. Instead of getting maybe $1,234 a month, 20% is $1,500. That'd be nice to have a little bit more money in there. So you really want to look at get educated on all your choices, all your possibilities, and make the right choice right out of the gate. So here's the big question is, when should you start your benefit? And those of you who get a statement, I don't know if many of you are getting paper statements, but generally you'll see a benefit for age 62, which is usually the earliest unless there was a death, a spouse or former spouse passed away, then it'd be 60. Then there is the middle block here is based on your birth year. So it all depends on what year you're born, what your full retirement age benefit is. Oops, let's go back there. That's full retirement age, FRA. We'll be talking about that a lot. It's based on the year you were born. And the highest benefit you would receive is at age 70. So when should you take it? Well, if you take it at your based on your birth year, you will get your full retirement age benefit. If you take it earlier than that, you'll get a cut. If you take it later than that, you get more, obviously. So basically, every year you wait past your full retirement age, you get 8%. It's simple interest, not compound interest, but 8% more per year until age 70, and then it maxes out. And if you take it before your full retirement age, it's somewhere between 62 and your full retirement age, say it's 66, it's somewhere around a 5 or 6% simple interest increase. So you could end up with a lot more money if you can wait, but it all depends on everything that's going on in your personal finances. So here's an example of, well, here's actually the birth year. We look at what year you were born in this column on the left, and they'll tell you what your normal or full retirement age is here. And so here's an example of what if I say, hey, my full retirement age is 66, and say you're born in 1958. We'll do that one. Born in 1958, your full retirement age is 66 and 8 months. Well, say your full retirement age benefit would be $1,000 a month. If you took it at age 62, instead of waiting, you're going to have a hit. How big a hit? Well, instead of getting 1,000, you'd get 716, so 28% hit per month for the rest of your life. So if you need to be prepared and comfortable with that, and it might make sense, all the sense in the world to take it then at 62. It depends on if you feel like you have longevity, what other sources of income might you get. We like to plan this where we look at if we can wait a little bit longer till 70 and maybe spend down some taxable IRAs and things. We're trying to make your Social Security later so it won't be taxed. So we'll talk about that in a few minutes. But whether or not your Social Security benefit is taxed depends on your adjusted gross income. So if you're getting money from an IRA, that's income. So we're trying to balance all of these things to make sure to see if we can minimize your taxes and fees and maximize your return. So Social Security retirement income is calculated from your top 35 earning years. They don't have to be in order. They're just a rolling the top 35. So if you retire and you're still working, those still count. So it's always your top 35 years. So you can get a raise in retirement if you're making more in retirement than you did before retirement. And here's something we want you to think about. There's 3 possible benefits to plan for when you're looking at Social Security. There's your benefit. And if you are married now or were married before for at least 10 years, there's potential spousal benefit, which you would get up to 50% of the spouse's benefit. And I'll show you an example in a minute. And then there's a possible survivor benefit up to 100%. So let's go through a few scenarios here. Let's say that you're currently married. Let's say one of the spouses had little or no earnings history, but married to someone else who did pay into Social Security. So here's the example. Let's just jump right to there. John and Diane are married. Let's say Diane stayed home to raise the kids and has no earnings record of her own. She did not work for a job where she pays Social Security taxes, but John did. So let's say when John files and takes his Social Security, Diane can apply for her spousal benefit. Well, how much would Diane get? Well, let's do the numbers here. Let's say if John's benefit is $2,200 per month. Let's say Diane's benefit would be half of that, which is $1,100, only if she applies at her full retirement age. Well, what if she said, well, I don't want to wait. Maybe her full retirement age is 66. She said, I don't want to wait until 66. I want to take it earlier. John took his. I want my spousal benefit. Well, how would that affect hers? Well, if she applies at 62, she will only get 35% of 2,200, which is 770. So quite a drop from 1,100 down to 770 per month. that would be the effect of taking it early. So if you take your own benefit early or a spousal benefit early, then your full retirement age, you're always going to have a cut in benefits. Well, what about divorced spouses? Well, you could receive a spousal benefit based on your ex-spouse's work record if you were married at least 10 years. That's the number. And you're divorced 2 years and not remarried, then you can receive up to half of his or hers or your total benefit, whichever is greater. So you need to do a little math there. And your ex-spouse, though, must be eligible to receive a benefit. They must be at least 62. So you can get a benefit from a divorced spouse as long as you're not married now. If you're remarried, then it would be the current spouse that you're married to that you would get a benefit from if yours is not very large and theirs might be bigger. So here's some exceptions, though. I want to make sure if you or your spouse work for an employer in which either one of you did not pay Social Security taxes, you might be subject to these two things. Windfall elimination program or government offset pension. These are two things that could decrease either your own benefit or your spousal benefit. So you want, if anyone has that situation, give us a call and we'll help you figure that out. But basically, those words are Greek for you to know that you need to do more homework. So let us know if we can help you out basically there. So it does cut it back. You want to plan appropriately so there's no surprises. There's Med. Thought so. So anyways, what we do to help us out is we use a lot of technology to help us simplify these things because there is a lot of number crunching out there. So one of the tools we use is something called our Social Security Analyzer. And we look at different scenarios. Here's one scenario, here's another scenario, and here's another scenario. So we look at husband and wife or someone in the ex-spouse, if you know the numbers, which the Social Security office can tell you. But here's one strategy, file at your full retirement age, file at age 62. This is no longer available, file and suspend, or it is for people who locked into that for a couple of years ago. But there's three scenarios here, and it's showing at the end what are the cumulative benefits of doing scenario 1, 2, or 3 over your lifetime. How much more money, how much would you get over your lifetime? And in some situations, it might be, if there's a big difference, if you look at that, if I did scenario 1 versus scenario 2, and there's over my lifetime, $193,000 difference in benefits I get from Social Security, you might want to know that before you make a decision. So when we're done with this, we'll send you out a feedback sheet, and you can request a free Social Security analysis meeting with us, and we can go over some of these numbers if you'd like. We also, another tool that's fabulous, people ask me all this time, do I have enough to retire? Until they see it, number crunched on paper, they might be a little insecure about that. Well, this is software that we have that we let our clients have access to. Also, it's online, but we can look at, do we have enough for what we want to do? And we say, quickly, we can say, well, let's change what your retirement expenses are going to be. Let's maybe change when you might retire, how much you're putting in your 401k, how you're invested, which Social Security strategy should you use? Debt proposal, should you pay off your house? Should you pay off your house or invest it? We can look at all those options and gives you information fairly quickly. On this example, this proposed plan of doing something different than what the current plan is, the proposed plan, would end up getting this one client $616,000 more money over their lifetime. That's good to know. So the tools help us a lot. We'd be happy to help you out and look at some of these things. Just let us know. There we go. So here's a question I get asked all the time. Can I still work if I take Social Security early? Well, what's early? Basically, prior to your full retirement age. So you need to know what your full retirement age. It's different, again, based on the year you were born. So if you take benefits before you reach your full retirement age, they might Social Security will hold back some of your Social Security benefits. So there's two tiers here, thresholds. There's a lower threshold and an upper threshold. The lower threshold, this changes every year. So this is new to 2019. This changed from last year. The Social Security Administration, SSA, withholds $1 for every $2 of earnings in excess over $17,640. So for every $2 of earnings over this number, they're going to hold back $1 of your Social Security. And that's if you are 62, 63, 64, 65, in there somewhere. That's the limit. They really want you to wait to take Social Security. The higher threshold is actually in the year you reach your full retirement age. That's FRA, full retirement age. The Social Security Administration withholds $1 for every $3 of earnings over the amount. The amount goes up the year you'll actually turn your full retirement age. You can earn up to $46,920 without Social Security holding any of the benefit back. So say I turn my full retirement age in June. That means from January to June, I can make up to this amount of money, $46,920, without the Social Security holding back any of my benefit. If I went over that, they would hold some back. And the question is, do they ever give it back to you? Well, they say that basically once you reach your full retirement age, that amount they held back is built into your lifelong paycheck going further into the future. So again, these thresholds only apply to earnings for months prior to earning your full retirement age. So it's some things to think about, to be aware of, so there's not a surprise. You make too much and you're taking Social Security, you might not get all the Social Security you were planning on. So you want to know that up front. Here's a big one, taxes. And we really try to help people minimize taxes, which could be, in some cases, a bigger impact than your returns in the market. It's a big deal. A lot of people are not planning for this. But does everybody's Social Security benefit ever get taxed? So you're getting Social Security, you're getting $1,000 a month for Social Security. Do you get to keep all of that, or is that taxed? Well, it's a little complicated, but bottom line, there's a tax table, and if we can help anyone, just give us a call or write something on your feedback sheet. We can go over it with you. Be happy to. But there's two categories here: if you're married or single. And what they do is they look at what half of your Social Security benefit is for the entire year. And if you're married, it's both of yours. So what was half of the benefit? And then they look at your adjusted gross income, and they add those two things up. And if you're married and it's below $32,000, then none of your Social Security would be taxed. And if you're single and it's under $25,000, none of your Social Security would be taxed. But if it's over those amounts, up to 85% of your Social Security may be taxed. So that means if you're getting $1,000 a month from Social Security, what's 85% of $1,000? $850. So $850 would be taxed at whatever tax rate that is your tax rate based on any other income you have. It's just regular tax tables that we have. So you might want to know about those kinds of things. We're trying to help people lower their adjusted gross income in retirement so we can reduce how much of their Social Security may be taxed. So we try to do that. If we have some time to work on that, a few years, we can maybe move some things around so that we can reduce your taxes on your Social Security and other things as well. So questions to ask at the Social Security office. If anyone wants a copy of this, we'll email it to you. When you go to the Social Security office, it takes a while. It might take a while to get on the phone, to set an appointment. You don't want to call Monday mornings. You want to call a little early, maybe Tuesday, Wednesday, Thursday, and you might be on the phone for quite a while. But you want to be armed when you get in there. And so you want to have a list of questions. You want to make sure you're taking good advantage of the time there. They will answer all your questions, but not necessarily, I think, will they sit down and strategize with you. You need to know what are your options, what information, what numbers. They have all the numbers for spouse, ex-spouse, everything. They have that. So we can email you these questions to us at the Social Security office. If you put that on your feedback sheet, that you'll get again in an email from us soon here. So these are important to know. Common reasons why retirees run out of money. We are talking about Social Security and income planning both, because you can't talk about one without the other. So we're looking at some of these things here. So let's look at why are people running out of money. We're really trying to take all the assets that you've accumulated and replace. The name of the game is replacing your paycheck for the rest of your life, so that you're pretty certain, feel pretty confident you're not going to run out of money. Then you'd be more confident in making that decision on retiring. But basically, we are living longer than we planned. We've had a long time of low interest rates, and they're rising. They're rising now with the Federal Reserve increasing those interest rates. We've had the last 2 years interest rates increasing to get it back up to normal, but we're still not quite there, and we don't know what's going to happen in 2019. But that has affected people on CD rates and bond rates where they didn't really earn as much as they thought in the past that they could. But that will be changing hopefully with interest rates going up. But you want to look at those things. Here's something I think that's on a lot of people's minds: is a volatile stock market. That's the market reacts to things it does not expect. If something unexpected happens, then it goes up or down. It affects that. So it's very volatile these days, and so we want to make sure that we're protected as we get closer to retirement. Lots of different things you can do to lower the volatility. We do risk analysis and things for our clients, because we want to make sure that they understand the possibilities of, based on what they're in, what do you expect in the future could happen up or down, and so there's just no big surprises, and then so you might end up selling low. You don't want to do those things. We did have a webinar last week. We talked about understanding market corrections, and I talked about all the history of what did the market do in the last 100 years, basically. It's pretty normal what we're going through with a correction, but we feel like we're kind of pulling out of that a little bit. But your expectations have to fit what's going on in the future, or you might make decisions that would hurt your investments. So you want to make sure you are in something that makes sense for you. And what we do for our clients is we send them out something called Riskalyze, and they answer some questions. And they get a score from 1 to 100. And that's kind of like a speed sign. How fast do you want to go? For this example here, someone's score was a 45 out of 100. So it's sort of more moderate. And then we looked at what they were doing over here. It says current portfolio. They were actually in risk of 77, a lot higher risk than what they wanted. So we adjust that back down to something closer to lower your risk to match your expectations of, more than anything, is losses in the market. You want to manage that so you understand that, and you want to reduce that as much as possible if you can. So we're looking at reality to help you sleep better at night, but still meet your goals. You want to be able to do that, and we can plug all that in to say, hey, is this going to work for you down the road? You're going to have what you need for the rest of your life. We do look at different places, since we're insurance licensed and we're investment licensed, and I'm a certified financial planner. We look at all these different areas, but you might be in too much risk here. We look at things with annuities. We do both. So everything is in one basket. We look at annuities that are very safe, low risk down here, but have some upside potential, but no risk. So a combination of things in the market is great, with maybe a combination of safer things over here. Again, it's very individual depending on how you feel and how comfortable you are, and making sure you know if you're going to meet your goals. We talk about annuities a little bit here too, because annuities can be one of those things that provide income for the rest of your life, a guaranteed income, but there's a lot of different kinds out there. So they're not necessarily a fit for everyone, but you want to make sure, if you're looking at that you understand the fees and all those surrender periods and all that. But there's some good ones out there that can kind of act like a personal pension and help you have some safe money for the rest of your life. Some have long-term care built into them. But maybe a combination, things in the market, things that are totally safe, maybe some things in the bank, all these things. We look at all of these things to make sure that we're offering what might be important. Here's an example of what an index annuity does. It's linked to the market, but not in the market. Here's the stock market, the red line going up and down and up and down. The index annuity is the green line. It goes up when the market goes up, but when the market goes down, it just goes straight across. So it doesn't ever, you don't lose anything. So it's a safe place to put your money. There's different ones out there that participate in 50% of what the market, the upside, but if the market goes down, you don't lose anything. So, and then you can turn them into guaranteed income for the rest of your life. So it's a way of providing income alongside your Social Security, perhaps with a pension also. So again, as long as you live, you get some kind of paycheck. Here's the government, the GAO did a study a while back. They were worried, I think this was 2010, about people running out of money because there are fewer and fewer pensions out there. So they did a study about all different annuities out there. And if anybody wants a copy of this, we can email it to you. There's a nice summary there. But basically they look at, oops, let me get back over here. They look at using annuities to provide lifelong income if you don't have a pension. So if you'd like that study, let us know. We'll email it off to you. Another thing that people don't look at enough as things that can have you run out of money quicker than you think or not provide what you want for your retirement is the cost of fees. They're huge and they're hidden. They're in all kinds of things. You want to know what all the fees are, what are in, if there's overarching fee, annual fee, fees built inside of investments. You want to know because that'll eat away at your investments. And we can do an analysis on that if you'd like to see what you're doing there and show you what that is. People are not looking at taxes enough and looking at planning. Not, this is after the fact what I did, let's do my tax return. You want to prepare up front, which bucket of money should I be taking money from so I can reduce my overall tax liability ahead of time. And also we want to make sure we're looking at inflation when we're building retirement plans. We start with expenses, a budget of some sort, and then it goes up over time. So you need to make sure that your investments are keeping up or surpassing that. But these things chip away at your nest egg. And we are having another class if anyone's interested. We're calling it Retirement Termites. And we're looking at all these different things. And it's a live class here in Belmar in the First Bank building on February 9th at 10, I think, in the morning. So we're looking at how all these things might affect your retirement portfolio. So let us know if you'd like to attend. So the most common reasons really why people run out of money is lack of planning. Here's the pie of all the different things that affect your money. They don't stand alone. They all are they're related to each other. I had a couple come to one of my classes a few years ago, and they had a nest egg. They had $500,000. They both had a nice Social Security benefit, and they told me at 65 they retired. At 65, they turn on their Social Security at 65 and they start pulling out money out of their investments. And they were really happy with how their investments did with their advisor. They had a nice return. Well, they were 75 when they came to see me, and they were down to 125,000 from 500,000. And they're having an issue. Well, and I said, well, how did you plan? How did you plan on spousal benefits with Social Security? How did you fare when the markets were down? How did we do bucket strategies? We take the safe money, and then you have things out in the future that can be more risky, but you're not planning on using it today. How did you plan on all of that? What did you do with that? And I said, we really didn't. We just started. Our advisor said, hey, we're getting 8%, take 8% out a year, turn on your Social Security, and they didn't have a plan. So that's the biggest thing is as much time in advance that you can start planning, can help you with this. And so Social Security is a big part of that, but all these other things are very important too. What kind of investment should you be in? You don't want too much downside when you're closer to retirement. You might want safer kinds of things. We want to reduce taxes. We want income planning. It's just how do I replace my paycheck? How do we do that? Social Security, they're all together related. Our Medicare premiums today are linked to your income. The more income you have, if you have more income, your Medicare premiums could cost more. And I've had people come to me and they were shocked. This one person told me, boy, my Social Security keeps going down. I'm like, well, what's going on? It doesn't just go down. Well, he didn't realize they sold a house. He had a lot of capital gains that popped up their adjusted gross income, and now their Medicare was outrageously expensive, but they didn't know that. So all these, they're related. We want to make sure, there's strategies. We can reduce your taxes on your Social Security, not have your Medicare go crazy, look at long-term care issues, look at all these things that affect your life and then the next generation if you're interested. So what income source is best? There's different ways to create income to go with your Social Security. What we do is we look at safe money and stock market investments both. I'm a fiduciary, and it might be a good idea to look up, if you're not working with someone, to look up fiduciaries. And that means we are putting your interest, legally obligated to put your interest before ours or our companies. And that's why I'm an investment advisor and a certified financial advisor, because we get to pick and choose anything out there. We don't get paid more or less. It's all the same. So if it's all more or less the same, which ones will we pick for you? The ones that will help grow your account, because you'll make more money and we get a % of that. So fiduciary is really, really important. But I wanted to say, this is a picture of my dad, and he was super honest, the most honest man that I ever have known in my whole life. He passed away a few years ago, and he really taught us to do the right thing for folks. So that's why my whole life I was a stockbroker, commodities broker, and I didn't like some of the things that were going on there. It really led me to become an independent fiduciary and a certified financial planner, to have all the tools and everything to really plan as well as I can for my clients. So, bottom line is you might want to have you need to have a retirement solution, a written, annually updated retirement income plan, a custom tailored to your needs. We also do this with our software for our clients too, or we have hard copy. But to do the software, to look at all what ifs all day long, to see how one decision, should I pay off the house, should I do this, should I do that, influences your plan for the rest of your life, is really important. So we help our clients do that. So if you're interested, in setting an in-person or online appointment, we do webinars for appointments too around the country. So we can look at what you're doing now, talk about your goals, and give you some comments to see if we think you're on track, basically. So we can look at all these things: Social Security analysis, all of these analysis on the risk, if you're taking too much risk, if you're paying too much in taxes, you're paying too much in fees. Income analysis, how do you create that? That gives people peace of mind when they know and they feel like they are on track. A second opinion on, bring in your plan and what you're doing now. Let's take a look at it. There's no pressure. We're just love to meet you if it makes sense. We'd love to help you out. And we think about this too. I have a lot of advisors sending me their clients to help them with Social Security planning. And I'm like, how can you do planning? That's such an integral part of it. How does it all fit together? So what else, if your advisor, we have one, they're not helping you with that, what else could they be overlooking? We try to stay up on things all the time. Here's a couple upcoming classes that we have in person. Again, this Saturday, if you'd like, we'll go into a little bit more detail with what we did today. It's this Saturday, 10 in the morning. Oops. There we go, back here. Sorry, keep hitting things. First Bank of Belmar, we're here on 550 South Wadsworth in Lakewood. So we're doing that at 10, an hour and a half this Saturday in person. And then February 9th, we're doing retirement termites, how to protect your nest egg from things that'll eat away of it as in taxes and inflation and fees, things like that. So that's also will be in Belmar. We do have some other ones coming up we're going to be doing some things in Golden and Buena Vista, and a few other areas are coming up. So check back our website, or you could get on our little newsletter thing we send out what we're doing. Let us know. So thank you for listening today. Appreciate you coming by. We will email you a feedback survey link. And if you'd like to sit down and talk in person, or again do a webinar, let us know. If you complete the survey, we'll give you our Social Security Power Pack, which has a lot of things in there. We have tax updates, risk tolerance questionnaires, budget sheets, all kinds of things to help you do some planning. So let us know if we can help you with this, but whatever you do, you should be, if you can, do as much planning as possible. And we're looking at trying to get every dime that